Okay, so if we're looking at restatement method, okay, if the functional currency is the US dollar, then we'll use the temporal method. If the functional currency is the local currency, for example, if you were doing business in Dubai, then you'll use the current rate method. Okay, so here's some examples of that. A Mexican subsidiary of the US firm has the peso um, as its functional currency. A Japanese subsidiary of the U.S. firm has the U.S. dollar as its functional currency. All right. An Australian company subsidiary of a U.S. firm keeps its own records in Australian dollars, determines its functional currency is the euro. So these are the three options here. So let's look at these. Okay, so you have to decide, how you're rolling basically when you get to these situations. A lot of times it depends on the local government. I know that in uh, some of the United Arab Emirates, they really push towards uh, the local presence, and so they most likely they would want you to be using their currency there um, as its functional currency. So here's example one. So the local currency is peso. The functional is the peso, and then we would report in U.S. All right, in example two, we had a situation where our local was the yen, but we were using US dollars, so our reporting is US dollars. And then the and then the third one is the Australian. We're using the euros, and then we're going to measure to US dollars. And here, you're going to have to remeasure it to euros, translate it from euros to US dollars. All right, so and then with the yen, the Japanese, you're going to have to remeasure it from yen to US dollars. And then the very first one with the peso, all we do is translate the peso from peso to US dollars. So these are the three different scenarios. Okay, so exchange rates. So the current rate method will convert financial statements using current for year-end assets and liabilities. Historical equity dividends retained earnings are not translated, and then current average um, revenues and expenses. All right. The remeasurement or the temporal method will convert financial statements using current for year-end monetary assets and liabilities. Notice that's different than translation. Historical other assets and liabilities, historical equity and dividends, and current average and historical revenues and expenses. So let's look what happens when you're in a high inflationary economy. All right, so how do you measure inflation in functional currency? For subsidiaries of the U.S. firms in highly inflationary economies, and the one that's just popping into my mind right now is Zimbabwe. Assume that the functional currency is the U.S. dollar, all right? So, and then remeasure the statements using the temporal method. So high inflationary is equal to high inflationary basically means that the current inflation um, is over 100% or more over 3 years. And two places that I'm thinking of, and you can fact check me on this, are Zimbabwe and Venezuela. So, now that we're here, I just got to check. I just got to check really quick. This is a good old time for good old fashioned Google. I am almost positive that I'm right on this, but inflation kicking it. Yeah, it is. It had hyperinflation beginning in 2007 in Zimbabwe. Not Zimbabwe. Zimbabwe had hyperinflation. So if you're curious about it here, I'm going to show you Wikipedia. See if you can see my phone. You can't. Hyperinflation. So look up Zimbabwe. That's a big one. Okay, let's get back to it. Let's look at the foreign currency financial statements. Uh, Foreign assets and liabilities are translated using the current rate at the date of acquisition. So again, remember how we figured out in that chart whether it was what our functional currency was going to be. Um, And we have to do that step first. So once we figure that out, then we can decide if it's equal to the local currency. So if it is, then we can go ahead and do translation and do a fair value book value differential. All of that's performed in the local currency, and then the results are translated at local rates. All right. Foreign assets and liabilities are translated using the current rate at the date of acquisition. So what if it's a remeasurement at acquisition? If the functional currency is the US dollar or the reporting currency, remeasurement is appropriate. And you just do the fair value, book value differentials. And the way you do that is the earliest rate is generally used in the date of acquisition. So that will be your earliest historical rate to use. All right, now let's go talk about your favorite thing, which is non-controlling interest. So for remeasurement and translation, the consolidation process is applied to financial statements as restated in US dollars. Measures of non-controlling interest and non-controlling interest share and controlling interest share are all computed in US dollars. Isn't that nice and easy for you? Well, I mean, it's not nice and easy, but it's a little less, right? All right, so let's look at the current rate method. So the thing about all these different facts and figures, there's so much here to remember and do. The best way to do it is just take these notes. If you're coming and using this study for the CPA, a lot of it too is just practicing the problems and looking at the different comparisons. So what I would do is go to that sheet where we did the yen and the peso and the Australian, and then walk a problem through each of those scenarios to practice. All right, so let's look at assets. And you can see this little chart is pretty helpful. The main thing is when you remeasure to functional, the cash, the DDAs, and the time deposits are all going to be current. The marketable securities are historic until you translate, and then they're current. So it's probably easier to remember the things that you do historically, and then just assume everything else is current. All right. Again, same thing. Remeasurement is mostly historic. Translation is mostly current. And then there's a few things that are historical. Current translation, those all have to do with stockholders' equity. All right, and again, same thing with revenues, expenses, mostly current for translation, mostly historical for remeasurement. Okay, so let's look at foreign investments. So let's say the U.S. firm has a foreign investment in its accounts under the equity method. If the functional currency is the local currency, then translation is appropriate. So what you'll do is you'll analyze the fair and book value, compute your goodwill in the local functional currency. And then annually, this is just like the most normal way this rolls, okay? If you're using functional currency as local currency, this is pretty much your role. Annually, you translate it back into US dollars. Of course, you are doing those currency realizations, right, for gains and losses on currency translation. And then you're going to record other comprehensive income for the OCI, other comprehensive income. So here is an example of OCI here. You can see right here, and I was talking about those gains and losses, it goes in as translation adjustment. You can see here the acquisition cost, the cash, and then here's the translation adjustment at the end of the year right here, comes in as a debit. All right, so let's look at 12/31/16, Max acquired Star. Star had an unrecorded patent of 100,000 euros. The exchange rate was 150. The patents amortized over 10 years. The average at year-end rates were 145 and 140. Okay, so here again, here's our expense. And you can see in 2017, remember with the patent, we don't keep a separate amortization account. We just take it right against the patent. That's the beauty of using the patent in these examples, because you don't have to worry about accumulated amortization. All right, so the OCI adjustment for the patent is 9,000. And let me just kind of walk you through that really quick. All right, you've got the 150, right? The 150, which is the exchange rate. So that's where we get our 150,000, right? 150 times 100. All right. Then the next thing we're going to do is we're going to look at the average and year-end exchange rate. All right. So if it's over 10 years and it's going to be $1.45, the average rate's 145, the exchange is 140. For the year-end exchange, I'm sorry, the average rate, by my time. Average rate is 145, year-end exchange is 140. So here, as you can see, we're using the average rate for our expense to take that down, the 14,500. Then the last little tidbit is our end of the year, is where we do our 126. Subtract those out, and we have a translation adjustment of 9,500. Not too hard to do a translation. So we're going to do this current rate example. We're going to translate the adjusted trial balance of the assets and liabilities at year end using current rate. We're going to translate the equity at the historic rate from the date of the related transaction, except retained earnings, which is a composite rate from each year. Revenues and expenses will be at the average rate for the related period. Okay, the entity needed to balance the trial balance after the translation is complete will be an entry to accumulated other comprehensive income, and thus will appear on the balance sheet. And there's a calculation for it, and I'll show it to you. Okay, so here we go. This is everything translated, and you can see the different amounts, cash rate, cost of sales, depreciation rate, following the rules, and all those rules I read out earlier. And you can see where the little star is. It says, see next slide. Couldn't get it all. So here is our calculation. So because all debit credit balances are not using the same exchange rate, the trial balance is not going to balance. And so what happens is, because we're at different rates, it's 28,600 less than the credits. And so the debit to OCI at the end of the year basically just becomes a plug. Okay, so we remeasure the adjusted trial balance, assets and liabilities at the year end, the non-monetary assets at the rate from the date of transaction, the equity at historical rate, and except retained earnings, which is a composite rate. The retained earnings is different. You saw that. If you want to scroll back and look at those worksheets, I highly encourage it. We'll remeasure the adjusted trial balance, and we'll remeasure revenues and most expenses at the average rate, cost of goods sold, depreciation, amortization at the historical rate. All right, and the entry needed to balance the transaction will be an exchange gain or loss, which will be on the income statement. So basically what happens is you roll in item by item, following whether or not you're doing the different rate, either an average or a rate at the end of the year, and you go in, you remeasure it using the exchange rate, and then you plug whatever the overage or underage is to comprehensive income or exchange loss. Okay, so here again is our situation for the temporal method. Okay, so here again you can see in the temporal method you decide based on the rules we read through, all those rules, whether you use the historical, the current, or the reciprocal of the US dollar amounts, the different exchange rates. And then the last little bit is finding the gain or loss between those, and again finding the exchange loss and doing a plug. So really, it's, again, what I said earlier, multiply it through the rate, get to your amount, and then once you've decided if you're doing it right, go through, like if you're doing this problem for homework or if you're practicing one of these problems, go through and make sure. The hardest part here is following the rules as to whether or not you should use a historical or a current rate. That's really all there is to it. Okay. Again, the summary, the remeasurement gives you exchange gains and losses. If you have a credit, it's an exchange gain. If you have a debit, it's an exchange loss. And then the translation results in part of other accumulated OCI. So really, this is just more for the OCI section. Okay, so here, let's look at the differences in methodologies. So here, let's put some big picture thought behind it. In the temporal method, the US dollar is the functional currency of the subsidiary to best reflect the relationships of the subsidiary as an extension of the parent. And thus, the remeasurement option is part of the current period income. So a lot of this is where we're consolidating and taking it in the income. All right, under the current rate method, when the local currency is the functional currency, okay, not the US dollar, to best reflect the subsidiary status as a freestanding company in whom the parent is merely invested. Thus, the translation is shown on the equity section. So in the temporal method, we're showing it as, hey, we are a U.S. company operating a subsidiary in a foreign country. Like we are over in Japan operating a KFC, all right? Under the current rate method, we are in Dubai operating a Dubai-owned ran company over there, and we want to show it as a freestanding company because of the local politics and rules. So then we would use the current rate method. All right, so last but not least, I'm going to roll through this kind of quick. Foreign currency, financial statements, consolidation of foreign subsidiaries. The parent uses the appropriately transmitted and remeasured subsidiary financial statements in its consolidation worksheet. Income from the sub and the investment in the sub are eliminated just as we have done in the past. Subsidiary equity amounts are eliminated, including accumulated OCI, and worksheet procedures are similar for that of domestic subsidiaries. Okay, and I'm not going to roll through too hard. You're welcome to kind of read the slides. I didn't put this in your homework, but I'm just going to pop through this just so you can see in case you're interested in practicing. And then we're going to hit hedge of net investment. So remember, if we have a hedge to hedge currency, we have to measure hedge effectiveness. So what do we do with those hedge effective measurements? We put those into accumulated OCI. Again, hedging is speculative, so we have to recognize that income in the current financial period in which we took out hedge. And that's it for today.